Thank you for joining us for our third quarter outlook titled We've Landed. For those of you that saw our outlook at the beginning of the year, you'll recognize the Olympic gymnast theme on the balance beam. The gymnast represents the economy and the economy's response to the Fed's rate hiking cycle in an attempt to tame inflation. How the gymnast lands will represent whether the economy tips into recession, which is hard landing, or avoids recession, which would be a soft landing. Our view, of course, has been there's going to be no recession, and the thesis is that this is the year that we would know for sure whether the Fed was successful. Well, 6 months into the year, we believe the Fed has been successful, and we have now executed a soft landing. Against that backdrop, we leave you with the following takeaways. The economy is on a stable footing. Pandemic excesses are normalizing. Inflation's been tamed, but prices remain high. And the labor market has weathered the Fed's best shot, and unemployment has been very resilient. And finally, earnings. What drives the market? AI has really helped preserve earnings and provide earnings growth that has driven the market. Now, the economy, the stability we talk about, this page shows economic measures at the beginning of the year in blue versus where we are today in gold. You'll notice that unemployment has gone from just 3.7 to 4%. Fed funds are unchanged at 5.5. Yield on the 10-year Treasury is basically unchanged from 4 to 4.3. Same is true for inflation. It's been sticky here around the 3% level. It's 3.3, began the year at 3.2. So again, the economy is very stable. Now, for the excesses related to COVID, one of the ones that's been normalized is consumer excess cash. In green here, you see excess cash. Of course, there was a lot of relief funds to help cushion the blows of the shutdowns. And you'll notice now that the consumer has spent that money. We're getting close to back to where we were pre-COVID. This helped shield the higher inflation costs because the consumer was able to keep spending. What that means going forward, however, is that spending is going to be tied to income growth. So consumer spending is going to be slowing. The economy will slow. The second thing that's no longer distorted is the labor market. Here is a data series that we've shared quite a bit over the last couple of years, and that's monthly data that shows how many people voluntarily quit their jobs. During COVID, when we came out of it, there was a very big dislocation between the number of people seeking work and the number of openings. As such, labor had the power and wages grew very rapidly from below 4% wage growth to almost 10%. People were easily quitting their job, finding a job that paid more and had better benefits, forcing inflationary labor costs higher. You'll note now as you look to the right side of this page that quits are now back to pre-COVID levels. So again, a normalization of something that had been very unusual and excessive, and also something that is helping to keep inflation lower. Now, something that hasn't normalized is government spending. The next data series here in red, you see government expenditures. In green, you see government revenues. In COVID, obviously, there was huge deficit spending. And this being an election year, we think neither party is going to try to get reelected based on the basis of trying to bring spending under control. This is a long-term problem. Near-term, this is not something that's going to lead to currency debasement. Obviously, the cost of servicing debt is increasingly expensive, and that's crowding out other more stimulative spending on infrastructure and things could be more constructive with government spending. But again, it's not something that's going to be a capital market event this year. Now, to why do we think we've stuck the landing and we've landed? The next page tries to address that very clearly. You take a look here at data when the Fed raised rates for the first time in March of 2022 versus where the data is now. Going left to right, in March of 2022, Fed funds were essentially zero. Fed raised rates very rapidly up to 5.5% where they are today. But it worked. If you look in the middle here, in 2022 of March, inflation was over 9%. Today, it's just barely over 3%. And the cost on the economy, which is generally when you raise rates that much, unemployment goes up from 4 to 5 to 6 to 10% at times. Unemployment was 3.6 when Fed raised rates for the first time. Today, unemployment's only at 4%. It's barely budged. The economy, in other words, has weathered the Fed's best shot. It's now been 11 months since the last Fed rate hike. It generally takes about a year for the full impact of every rate hike to be felt. So essentially now mid-year through 2024, we have now weathered the impact of the Fed rate hikes. Now, if the economy is on such solid footing and inflation is under control, why is consumer sentiment so negative? The page with the McDonald's large fry in the middle attempts to reconcile the two. 70 million people eat at McDonald's every day. In 2019, the average cost nationally of a large fry was $2.02. Today it's $3.42, a 70% increase. Now, food consumption is a non-discretionary expenditure. In other words, not optional. So food costs are this expensive, it's crowding out other expenditures on more discretionary basis. It particularly impacts lower income people, but overall, obviously, these higher prices that we're now dealing with on non-discretionary sort of expenditures is something that's really pinching the consumer, impacting sentiment, and also another thing that's slowing the economy and the economic growth going forward. Now, shifting to capital markets, halfway through the year, and it's been a great year for large cap US stocks. As you may recall, at the beginning of the year in our outlook, we had the image here in the upper right claiming that, staying with that Olympic theme, that large cap US stocks would be the dream team of asset classes, and that's certainly been the case. Halfway through the year, and the S&P's up over 15%. Comparing that to the other strategies and asset classes, you'll see that large cap value is up less than half that. International stocks and the Dow Jones are up less than half that, and bonds are up basically zero. So again, large cap US stocks have been the place to be. So why have large cap US stocks done so well? Because large cap earnings have done so well. To that end, the next slide takes a look at S&P earnings segmented in two categories. The blue representing what component of earnings are contributed by the technology and telecommunication sectors, the red representing the earnings contribution of the other 9 sectors. Expectations are for the blue slice, technology and telecommunications, to grow earnings this year at 20%, fueled heavily by the benefits and productivity gains delivered by AI. The other 9 sectors are expected to grow earnings 8%. So the total earnings expectations are for not $219, but $244, which is a 12% year-over-year growth. Well, earnings are up 12%, the market's up 15%. Now, as earnings go, so goes the market. And the market's not cheap. We said that at the beginning of the year. In order for the market to go up from here, earnings have to go up. And our expectation is we're going to continue to see earnings surprises on the positive end of the ledger as the balance of the year unfolds. As such, our asset allocation to overweight large cap US stocks, underweight small cap and international, we think remains an appropriate strategy for the second half of the year. Thank you so much for your time and attention. Be well, and we look forward to catching up with you in the fall.